Now, from Kevin. Kevin initially emailed us and said, when I've bought an option, I'm trying to figure out where to place my stop loss. So we're going to buy a call, buy a put, expecting a movement in the stock to take a leverage profit on the position. Do I base the stop on the underlying security itself? If so, how do I go about figuring that out? Does it have to do with delta or such? Well, when you've decided to use this leverage strategy in your portfolio, remember, of course, with a long call, buying calls or buying puts, a leverage position, the lie of leverage, leverage works both ways. You can lose 100% of what you invest in that position in the event of an unexpected move. So in general, you want to use this with a smaller portion of your portfolio. You don't want to have 50% or 80% of your portfolio invested into buying calls and buying puts. That's not really a good way to go. This wants to be a smaller portion of your portfolio, and you want to use more controlled risk strategies with the larger portion. But in any case, my direct response, my initial response to Kevin is, it's going to depend on your goals for this strategy approach in your portfolio. Why did you choose to trade long calls? You read somewhere that you have the potential to make maybe 50%, 100%, or 200%. You followed someone who had a series of videos, maybe, or a series of blog articles that talked about, hey, I made 300% on this trade. I made 250% on this trade. We've had 8 winners. I see those emails too. I get them all the time. What we don't see is the losers. What we don't see is the ones they've managed out 3 or 4 years, perhaps, to hide a loss in the hope that the stock recovers, and how much of that account is being taken in. But you want to have a balance here. So if your goal or your target that you think is right for what you want to make with this strategy, if you're looking to make 50% gains on buying calls or buying puts, maybe you're limiting losses to 20 to 25% of what you invested on the losers as a close, you may would just use the option price solely as a stop or contingent order. If your broker allows a percentage, you could do that too. You could set the alert in PowerOptions. Also, that wouldn't close it for you as a true stop with your broker, but it would give you an alert that, hey, you've made 50, 75% on this call, and then you could go and just take the desired action. Of course, you might have other targets in mind, and that's probably better. I think this 50-25 I mentioned, looking to target a 50% gain with keeping losses to 25, is going to cut too many winners potentially short. And it's going to probably have you closing out of losers too soon. Now, if I buy a call, if it's out of the money, I buy it for $1 and it drops to 75 cents, I'm out of that position with a 25% loss. That might have just been $1, $1.50 drop in the stock, and a week or two later, it might be up another 8 or 9 points, and I missed out on a huge profit. Better balance might be 150 in that range, keeping it at a 2-to-1 ratio. But again, that's what you would look for. Now, timing the stock is difficult. We all know that. We've all tried it. There are different technicals that seem to work better in some situations. There are other technicals that work better in other situations. But if you're looking to time the stock, whether you're trading a more stable position that doesn't jump around, say Apple or something along those lines, IBM, way too low, maybe McDonald's is way too low volatility, for example. But in other conditions too, you might want to consider using technical indicators on the stock itself. When we hit a point where the MACD starts to cross to a negative, in other words, I bought a call, the MACD starts to go negative, I might want to consider getting out of the position. The SMA 50 starts to change. The stock was trading above its SMA 20, SMA 50. Now it reverses and the stock's trading below the SMA 20. It's going the opposite direction. I might want to bail out of that, or using 2 or 3 of those in conjunction with one another. But things that you would use to target getting into the initial call, this is the stock I looked for. This is the stock I like based on the technicals. Well, those technicals that you use to get into a position to buy a call or buy a put are probably going to be the same technicals you're going to want to consider doing the opposite way. If the technicals start to change against you, you're in a bullish position, get out of the bullish position or look to manage it or hedge it because it looks like the stock's going the opposite direction. Now, one thing you've always heard me say in these scenarios, whether it's related to credit spreads, whether it's related to call buying or put buying, delta is a difficult one to use, because delta can adjust with shifts in implied volatility, which may cause a delta target to be hit even if the stock or option has not moved. In other words, if I'm doing a bull put credit spread and I looked for my put sell to be at a delta of less than, say, 0.2, and the stock's sort of trading along and it's dropping a little bit, but it's stabilizing, then some news comes out and the implied volatility of the options spike, my delta might suddenly go to 0.3, even though it's still in the same out of money range that didn't hit my trigger. It's still at a point where the MACD has not gone negative or anything like that. I might not consider closing the bull put based on delta because it might have just changed slightly because the implied volatility had hit my target. Same thing with the long call or the long put. But in any case, some investors I talk to, some power options users have a plan, I know, that they've gotten into a long call with a delta of, say, 0.6, 0.7. If they pick the right direction, this is usually farther out in time, leap options or things of that nature, and the delta moves up to 0.9, well, they don't want to be completely one-to-one. They want to adjust it further out. So what they would do in that case is go into 9, readjust the position, close their one that's at a delta of 9, and go back to the higher strike call now that's at a lower delta for their goals in the position. Okay, so that's just some ideas. But remember, general rules, as I said, this one is going to be quick. For more insight, head to our YouTube channel at Power Options. Check out our call buying long call playlist. Some videos you might want to watch in the playlist are when to expect a profit on a bought call or put, long call or long call spread, bullish call debit spread, when to close or exit, 8 ways to manage a profitable long call, and ideas for managing a losing long call as well. Of course, there are other videos there that are also very useful in that playlist and other playlists that we have as well. So that's just something to consider. And Kevin, I hope that helps you out. I did reply to him via email, but it always helps to just review that also on the videos if we have the time. It's just a couple of minutes there after the intro. Doug's question, using one of the tools in PowerOptions, says, Mike, if you have time, could you go through an example of the stock repair tool? I have 3,000 shares of GT at $15.92. Okay, so really simple access to the stock repair tool. What this tool is going to do is try to build a ratio call spread that gets us back to break even faster if we're in a stock that's declined, but we have a bullish outlook on the position. If and only if the repair can be calculated. On Fortinet, if my cost basis was $74 and it's now at $56, I'm probably not going to see a stock repair available. But let's check for Doug. GT, put in the stock symbol, click on the stock repair here over across from the symbol lookup page. And yeah, we'll do that. That's fine. Its cost per share is $15.92. Excellent. And we have 3,000 shares of stock. Usually I just do 100, Doug, but we'll use the 3,000. All right. Now let's see the details here. Stock is currently trading at $12.83. All right. So we're at a loss here of about $3, which is pretty significant on the position. We see no current repairs, Doug, available. We do see credit and debit repair. Always focus on the credit repairs, Doug, first if they're available. Find those better to use. So with this ratio spread I'm talking about, we're going to get a net credit on the position. What did the system do? Well, it tried to build different combinations at different expirations to generate a net credit. Here it's not a net credit, but it's not really a debit either. But it'd probably be a debit if you didn't get midpoint, Doug. But that's okay. And so by doing a combination ratio spread of the buying the 12 strike calls for January 2024 and selling the 14 strike calls, we lower the break even down to $13.96 with the stock at $12.83. Still pretty steep, but well below $15.92 if we don't do anything. First, let's take a look at the repair details. Now this shows us what we would be doing for this repair just in text form. To do the ratio spread, we're going to buy 30 January 12 calls at a price of $220. And we're going to sell 60 calls at the 14 strike at $110. Now this is $220 even, $6,600 back and forth. You can see that. So you have no net credit. Does this ratio spread, we're selling twice as many calls as we're buying, does this have infinite risk? No, because essentially what we're doing is we're doing a bull call debit spread at 14 and 12 with 30 contracts. So half of these 14 calls that we're selling are covered by the 12 strikes that we're buying and a covered call, because those remaining 30 strikes at 14 are covered by our 3,000 shares of stock. There's no margin requirement. You could even just sell the 30 calls at 14 with your broker and then enter the bull call debit spread if you're not allowed to trade ratio spreads. Same exact thing. Now, the break even is at $13.96. How does that happen? Because when the stock's at $13.96, we're down $1.96 from our position at $15.92. Yeah, we need the stock to go back to $13.96 on January expiration for this to pan out to get a better break even. But how is that possible? Because we didn't take in any net credit. Because remember, we bought 12 calls. If the stock's at $13.96, the 14s expire worthless. We sell to close these 12 calls that we received at no cost for $1.96, and our total value at expiration is $15.92. We're in a position where we've lowered the potential break even with the ratio call spread, the stock repair. We only need the stock to go back up about $1.10 rather than another $3. Now, it's great to see things numerically, and I hope that discussion you followed that, Doug. It wasn't too quick. But let's go to Analyze Trade. When you see a stock repair come up, you click on the repair details. It gives you that verbal look of what's about to happen, what you would do. When you click Analyze Trade, it gives you the profit and loss chart for the position. So best case scenario, if it's above 14, you only make 1.1%. But that break even here is at $13.96 from $15.92 because the gain is accelerated as the stock starts to move up, because you're getting back on your 3,000 shares of stock and the long call is appreciating as well. So that's why this extra ramp up in profit occurs. But yes, like I said, we did a bull call debit spread with a covered call, so the gains are capped to the upside in this case. If the stock moves above 14, you can always roll 30 of those calls, close the bull call debit spread out for full profit, and could just continue it as a covered call at that point in January if that's what you wanted. Does doing a January repair make sense? Well, it depends on what your outlook is for the stock, what you have coming up as far as earnings and everything goes, what your current loss is on the position. We see that, it's $3 on $16 essentially, so it's still pretty steep in that case. But again, if you feel, I take a look at this and I say, okay, I can get my break even to $13.96, but if I feel the stocks is even going to stay here, and I could get 40 or 50 cents per month, I know it's a stretch, but I get 40 or 50 cents per month for, say, the 13 call, and I do that between now and January. So I sell the September, October, November, December, and the January. 5 months, let's say at 30 cents, that's $1.50. Well, I only would have dropped my cost basis down to $14.52 if the stock's still at $12.83. So what I'm analyzing here is it better to sell at or just out of the money calls over time than the stock repair? And if the amount of money I can make over the same time with the current at or out of the money call premiums, knowing I'm going to have to roll sometimes maybe and add to the cost basis, but if that break even is still higher than the break even in the repair details or stock repair, Doug, I'm still probably going with a stock repair. But if I'm expecting that the decline we recently saw was more market-based, my stock is still leader in the industry, and I am expecting it to recover more quickly, and I expect it to be back by back up to $13.50 or $14, say by the end of August or September. Maybe I don't need to do this repair. Maybe I could wait for it to move back up. I could be wrong. Never hurts to add hedge, never hurts to add protection. But in that case, you might want to take another look at it and maybe sell some calls against it or do that. Just do selling calls on it over time rather than going so far out of time with a stock repair based on your expectations, based on your loss position, and based on what you're looking to accomplish. On that note, Doug, I know this was just a little quick review here, about 6 to 7 minutes. I hope that helps, by the way. If it doesn't, let me know. But again, at any time you want to review it more, we're in the playlists here, but we can go back to the Power Options channel where we were before, use that search icon there, and you know that anytime I put up a video, I'm going to have it in the title. So let's look up stock repair first. Comparison on stock repair ideas. Is it better to sell OTM covered calls to break even, use OTM covered calls and OTM put selling, or use a stock repair? This one I like because it compares those different ideas and discusses the stock repair. Here's another look at the stock repair. I thought there was another comparison here, but in any case, this one right here from 9 months ago discussing a means position I really like, because we talk about that aspect I just mentioned. Hey, is it better just sell? Shouldn't I just be selling out of the money calls against it month by month by month rather than use a stock repair that's 168 days out? Not necessarily. It depends on your expectations, what you want to see going forward. And of course, this other one here, how to manage or exit the repair, might be useful. And hopefully that means that if you're watching this video, you did the repair, but not only did you do the repair, but the repair started to work for you and you got back to near your break even before expiration. You're looking to manage it. And some of the tips here are going to help you out as well. And I just want to remind everyone, of course, that today's material are my thoughts and your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as recommendations or direct trading suggestions. Options involve risk, as we've seen today. It may not be suitable for all investors. Today we had a chance to look at the portfolio tools in action, from tracking, rolling, evaluating the rollout opportunities, the position analysis view. Didn't get into the patented search tool much at all today, but we did take a look at the stock repair and some analysis using the custom spread tool. We did show a little bit of the history to go back and get current prices. Well, if you like the tools you saw today, remember you can access them fully with no credit card required for 14 days. Just go to PowerOp.to, put in your name and email address, and then you have full use of the site for 14 days. After that, subscription starts just $45 per month. That is for the end-of-day data service, where the data is only updated around 4:15, 4:30 p.m. Eastern Time. An upgrade to that is the delayed service, just about 12 to 15 minutes delayed. That's only $65 per month. And then full access to the historical tools, about the 7 years of backtesting data. That's only $35 more from the delayed. It's just $100 per month for everything you get delayed, plus full access. We do, of course, offer the real-time service. And the premium service includes everything. There's no contractual obligation for a Power Options subscription. You can cancel at any time. Free coaching sessions are available on all levels of subscription, and you can upgrade at any time as well. Subscribers also have full access to the webinar archives. Speaking of which, as I mentioned, today's presentation was recorded. The full unedited, undisturbed hour and 25 minutes will be posted for Power Options subscribers in the requested topics section of the webinar archive at around 7:15, 7:30 p.m. Eastern Time. Other segments will be cropped up tomorrow and put onto the YouTube channel for public view. And again, of course, we already talked about the playlists, searching for videos and accessing videos on there as well. Videos will be available sometime tomorrow around 12 noon, 1 o'clock Eastern Time. If you think of other questions, send me an email at any time to support@powerop.com or support@radioactivetrading.com. Also call us during market hours at 302-992-7971. Remember, trial members and subscribers, you can also schedule one of those free coaching sessions at any time, essentially a 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site, answer any questions you have, just like today, but more on a one-on-one session. Typically done over the phone, but if you want to do it sort of over a screen sharing interface such as this, just let us know when you schedule the session, and Ernie and I will make that happen for you. All right, take care, everyone. Have a fantastic weekend. We'll let you know when the videos are available. Good night.